Hello and welcome to Wealthion. I'm your host, Andrew Brill. The market started the second quarter of trading with a thud after a great first quarter. Economic indicators seem to back Jerome Powell's comments about pumping the brakes on talks of rate cuts. We'll discuss all of that coming up right now. Our mission here at Wealthion is to help all of us keep and grow our money. But Wealthion's not just a channel, it's a conversation with our community. So please keep the feedback coming. If there's something you'd like us to talk about or someone you'd like to hear from, please let us know. And if you could like and subscribe to the channel, we'd really appreciate it. I'd like to welcome back Bret Kenwell to Wealthion. Bret is a former financial journalist and is now an options analyst for eToro. Bret, welcome back to Wealthion.
Yeah, thanks so much for having me back.
Absolutely. Now, let's get right into it and talk about the economy. And it seems like everything hinges on whether it's Jerome Powell says something or some economic indicators come in, but the market seems to go way up or way down with the newest economic data whenever it comes out.
Yeah, if we go back a couple months and look at what the bond market was pricing in and where investors' expectations were, we go back to December, really was not that long ago. Investors were expecting upwards of 6 rate cuts for this year to start in March. And the Fed had acknowledged that was probably people were a little too far over their skis on that expectation. And it didn't take long for that to pan out and to prove right. We got the hot inflation report in January, and not as if the market hasn't been hinging on every CPI report we get. But I think that really set in motion investors' focus on all of the really relevant economic reports, right? The labor market, the jobs reports, the retail sales, PCE, and inflation, especially those reports. And they're hanging on every word from the Fed, looking for clues on not rate hikes, rate cuts, wondering how many we're going to get, when they're going to start. And it's really just been hinging on every single report for the last 3 months.
And now you have the vice chairman who spoke on Monday who said, well, maybe we won't get any rate cuts this year. And now you see where the market is going. We were up 10% in the first quarter, and first couple of days of the second quarter, not so much.
Sure. Yeah, our approach at this point is we're optimistic, but also realistic, right? So the S&P rallied, like you said, 10% in the first quarter, and it also rallied more than 10% in the fourth quarter. So we're working off back-to-back quarters of 10% or more gains. The index is up 5 months in a row. So is the NASDAQ and the Dow. So after that kind of performance, it is hard to be bearish. And to be clear, we're not. We are optimistic, but at the same time, we're realistic. We can't expect these types of returns quarter after quarter. I mean, I wish we could, but we can't. So, at some point, it would make sense to have some weakness in the market and a pullback. Kind of the tough questions around that are, when will it happen? And when it does, what's the magnitude? But in either scenario, we're staying constructive on the markets because we're constructive on the economy. And until those two things change, it's hard to be too pessimistic.
Is there and I know there's the bulls and the bears. I don't know what's in the middle. I don't expect, I mean, you're the expert, and you're telling me maybe it's not going to be a 10% return, but maybe it'll continue to creep higher, but not by anywhere near as much of a percentage.
Yeah, it's hard to put a number on it. You see estimates change all the time as the market moves. Has a funny way of changing sentiment, right? Um, but the way I look at it is, I look at it as a path of least resistance, right? And right now that's to the upside. I don't know how far that path leads to, or how long it takes. It could take, we could be in the earlier innings of a multi-year bull run. We just don't know. And until things really change and deteriorate, I don't really plan on getting off the train. That's my, my personal belief in the market. And, when we stop, when we pull back a little bit, that's probably a good opportunity for investors who have been under allocated or have been looking for their moment to get in. That's probably their chance.
So we looked at, consumer expenditures, which just came out on Friday, ticked up about 2.5%. I guess it's around 2.8, 2.9%. The Fed wants to see that, and it's just being really stubborn to get down to that 2% level. But we do see a shift in expenditures where we were looking at a lot of people with discretionary spending, luxury goods, that sort of thing. But now consumer staples were up 6%, and the discretionary spending was only up 2.8%. So, could there be a shift in the way people are spending their money?
That's a good question. There could be a shift in the way that they're spending their money, but it also could just be, seasonally kind of readjusting a bit. We just came out of the holiday quarter, and people are kind of working off those expenses as we, go through the first couple months of the year. We had spring break kind of early this year, and it wouldn't be surprising to see people kind of, sticking a little bit more to the necessities over the needs instead of the wants. But we have the summer travel season not too far away, and overall, the consumer remains fairly healthy. So I wouldn't necessarily read into too much on where they're spending their money, just more so that they're still spending it.
Right, but wouldn't it make a difference if people were spending it on staples rather than luxury goods? Because these are things that, and manufacturing in those areas is seem to have ticked up a little bit also recently, whereas people need these things, and it's nice to see people spending money on things that they actually need rather than just things that they want.
Yeah, that's a great point. I mean, look, I think we see it also in the sector performance when you look at discretionary names. There has been laggards in that group, and the spending's been really mixed, right? You see certain pockets of strength and certain pockets of weakness, and it does kind of go back to questioning like the consumer's doing well, but there's obviously certain pockets within the consumer that has been vulnerable, that is maybe a little bit more sensitive to energy prices, or is more sensitive to higher interest rates. So it's kind of just finding that balance and taking, I think, a larger view of the consumer overall, and not trying to not getting too bogged down on 1 or 2 months of data. And I think that when you listen to the Fed speak, I think they kind of illustrate that purpose pretty well, right? Like when they're looking at the inflation report and they see a couple hot numbers, they ask, is this a bump in the road to lower inflation, or is this something bigger that we need to be aware of? And that's part of the reason why we see them being so patient when it comes to cutting interest rates. And they're lucky enough to have a strong economy where that is really buying them time. They can afford the luxury of waiting before making a decision on interest rates, because they want to feel confident. So I think if we were to see, staples outpacing discretionary spending, to kind of get back to your point, and that was a larger trend that continued to gain steam, then that would be more of a concern, I think, on the consumer overall versus just how they're spending their money and where. But it's one of those things I think time will tell. Let's get a few more reports under our belt and see where the chips fall.
That seems to be what the Fed keeps saying. Is like, oh, we need more data, and let's see where it's going. But some of the data says that prices actually ticked up a little bit, which isn't great for the or I guess it's good for the economy to keep going, but it's not good for the inflation rate or interest rates to be lowered anytime soon. So we have prices ticking up, and the unemployment numbers seem to still be really low at this point. We're looking at 2 years under 4%. How much longer can we go? I know we've been in this place where interest rates have been up for a while now, but unemployment now is still at a level that is very, very acceptable to leave interest rates where they are.
Yeah, as long as the labor market holds in, and to be very clear, the labor market in the US is the lifeblood of the economy. 70% of US GDP is consumption driven. So we're a nation that spends, right? We need to have jobs, we need to be employed, to not only feel confident in our spending, but to have money to spend overall. And as long as the labor market holds together, the Fed has a long runway in terms of how much time they have to decide on what they want to do with rates. And um, kind of getting back to the bigger picture, I guess, as the Fed kind of goes forward and takes into consideration when to cut rates, the labor market's going to play a big role, right? So we came into the year, the labor market was doing just fine. We had a really hot, strong number in January. The January number was very strong, but it was also revised lower. And the prior report also had unemployment rate ticked up from 3.7 to 3.9. That was not expected. And average hourly earnings were below expectations as well. So I wouldn't necessarily, I don't know if I want to go as far as to say there's cracks forming and showing there, but there are certainly little pockets of vulnerability, if we want to call it that. Um, I know that the Fed has spoken quite a bit about the labor market, and at this point, it does seem like they are not willing to sacrifice the economy. That they're not willing to sacrifice throwing the economy into a recession just to finish this battle with inflation. But if we can find this sort of harmonious level of existence where the labor market stays strong and interest rates have to stay higher for longer, then that's an environment we might just have to get more comfortable with.
But there is I know that we don't want to say there's cracks in it, but there's some weakness showing in that wages are definitely up. The data shows that wages are up, but 25% of the working class people, I guess, their wages haven't gone up at the same percentage as they're showing. Now, with prices going up and that 25% not meeting the inflationary rate, there could be a slowdown in spending relatively soon, I would assume.
Yeah, so far we haven't had any abrupt any abrupt breakdowns in consumer spending. We have had some retail sales numbers that have kind of brought into question how strong the consumer is, and it's really is certain parts of the consumer class that are being squeezed harder than others, and I think that's not necessarily a surprise, but it is reality. And for now, the unemployment rate and the labor market, it remains in an okay situation. Like you said, or like you said, I said, hesitant to call it, say there's cracks forming, right? But there's certainly little areas that I'm paying attention to, like this Friday, early April, we'll get the latest update at the jobs market. So be very curious to see the revisions from the prior month, very curious to see average hourly earnings and see if that unemployment rate moves at all. I think it's worth pointing out that in the Fed's last press conference, in their last meeting, they also released their economic projections. And in that projection, they did have a little more leniency on the unemployment rate. I think they had an expectation of 4% for the year, or maybe it was 4.1, but either way, it was fairly close to where it now quickly found itself. And they still expect 3 rate cuts this year. So obviously all those things are subject to change. And the Fed goes data by data and month by month. So we'll kind of see how their opinion forms over the next few months in that regard. But I think it is worth pointing out that maybe the Fed won't be so patient if they see the unemployment rate get up to 4 and maybe a little above it before they start really thinking there might be a risk to letting it kind of get a little more out of control than they want it to be and force their hand to cut rates.
I would assume, and with your expertise, obviously you research this stuff. Fourth quarter of 23, we listened to all these companies saying, "Oh, we're laying off this percentage of our workers," and we even saw that in a little bit of the first quarter with economic data that came in and earnings, and that hasn't seemed to trickle down to the unemployment rate at all. But I have to assume at some point they're their benefit from getting let go, or their relief package or whatever it is that they got is going to run out, and then they're going to go and fly off unemployment. I'm assuming the Fed, with their numbers, thinking, oh, you know what, we might look at 4% or 4.1%, is thinking the same thing.
Sure. And the thing about the headlines, it was like there was a stretch there where I felt like it didn't feel like a recession, but almost by looking at the headlines and the jobs market, it almost seemed like it could have been, I mean, but it was being hit so disproportionate versus certain other sectors and industries, especially in tech. I mean, those really made the headlines when any big tech name was laying off employees. It was kind of making a lot of news. And in tech, we have seen a lot of job layoffs, and that's one pocket, that is one area of concern. But on the other hand, the overall jobs market continues to hum along fairly well. The labor market remains fairly strong until we see that unemployment rate, I think, breach that 4% mark, and we start maybe coming in light on the headline numbers. There's not a lot to worry about in the labor market, but for me especially, it's something I'm definitely keeping an eye on, because at this rate, when I'm looking at the stock market, when I'm looking at the global stock markets, all this different sector strength we're seeing, that is really kind of the one main risk I see in the stock market. There are other smaller ones, but that's the main one, given how important the consumer is to the U.S. economy.
And when we look at the inflation number year over year, it's come down. But when you look at it at a much smaller time frame, month over month, you kind of see it creep up a little bit, and that's has to be a little bit of a concern, because if they start to cut rates, it's going to go even further in the wrong direction.
Yeah, it's the Fed could find itself in a little bit of a pickle, if we do have weakness, maybe a little weakness in the jobs market, but stubbornly high inflation. It kind of says, like, what are you guys going to do? Are you going to cut rates because of the economy or worries about the economy, or are you going to leave them elevated, putting a little more risk on the economy, but in an effort to fight inflation? And thankfully, they haven't been put in that pickle yet. And my hope is that we don't find ourselves in that pickle. And it kind of circles back to what we were talking about earlier with the speed bump, is the last couple of months, because, coming into the year, we were on an annualized basis, core PCE was basically back down to to the Fed's 2% target. I mean, there's a little wiggle room, and there's certainly arguments you could make the other way. But there was a moment there where you could argue we're at the 2% mark. It's time to cut rates. Now we've seen an uptick a bit in inflation. So it was good that the Fed was patient and didn't jump to those conclusions prematurely. But now we have to find out, is this a speed bump in inflation? Do we just have a slight uptick and we're going to go back on the trend we were on, coming into this year? Or is this an uptick that is going to be a little bit more stubborn and not go away? Whereas that would warrant, keeping rates higher for longer and not being so quick to cut them.
In your meetings at eToro, and I'm sure you guys talk all the time, and I know that Chairman Powell said, and I want to get this right, he said the timing of the cut is just as important as the cut itself. Do you see the timing at now? I guess we have to wait for the numbers, but kind of, and I almost feel like we have to go to FanDuel to figure out the percentage of when the cuts is. We all take bets and say, no, it's going to be June, it's going to be July, and we can all do it that way. But it's now seems like the June cut is less than 50%. The July cut is a little above 50%. When you guys talk, how many cuts do you think there will be, and the timing of those cuts? And I know it has to do with the numbers, but you guys crunch numbers, and that's what you do.
Yeah, it's, it's tricky. Just to be honest with you, it is tricky to kind of figure out when that's going to be. And I hate to kind of err on the side of like Fed speak, but it is data dependent. If we get a hot number, a couple more hot inflation reports, and the labor market stays strong, it's hard to be in a rush to see the Fed cut rates. And it's funny because you're thinking, okay, one rate, they raised rates, how many, couple 24 times. We're up to 5.25. What difference is 25 basis points going to make? It doesn't really make a much of a difference when it comes to the restrictive nature of monetary policy, but I think it sends a different kind of message, right? So it's like there's a lot of focus on one cut, even though it won't make a big difference. Like if rates were 4.75 versus 5, it doesn't really make a huge difference, right? It's a few basis points. But look at what happened when we went from, there's basically three main phases of interest rates, especially in our current cycles. There's a rate hiking cycle, which we went through, and we saw the repercussions of that. We saw it in mortgage rates, auto loans, the stock market got hammered when interest rates went flying higher. And then we went on this stretch where we had a pause. So we had a pause in hikes, and we just the Fed just maintained interest rates. And you saw what happened in the market. The market really shifted its how it was behaving when investors realized there's no more rate hikes. When they realized that, the market exploded. And that was, in the early parts of Q4. And now, we find ourselves in Q1, in Q1, we found ourselves looking for that first rate cut. And now in the beginning of Q2, we're still looking for it. But once the market gets the idea that we're done with the hikes, we're done with the pause, now we're on to the cuts, that could just be our next catalyst for the market, but for everything that interest rates impact, from mortgage rates to auto loans to borrowing in general. So I think that's kind of the main focus from investors, and why one hike might not, or one cut might not make a big difference on, a corporate balance sheet, but it makes a big difference in how investors and how C-suites are approaching capital markets and how they're approaching the stock market.
It's really affected the bond market. Just the 10-year uh, bond just hit a new or a new high for 2024, and it looks like it could go a little bit higher, and that's the mark that everybody looks at for mortgage rates and credit card interest rates. So if when that continues to go up, mortgage rates will do the same, credit card interest rates will do the same. So it'll really affect the consumer, and that'll affect debt as well.
Truly. It's a very important mark to keep an eye on. And it just, today, I think it touched a 6 month high, or very close to a 6 month high. And same with the US dollar. That's also at a 6 month high. So those are two smaller headwinds for the equity markets. Obviously, if you had told me, in December, when the markets had gone on this blistering rally, I think, they came into mid-December on like a 9 week win streak. The S&P ended the quarter up 10%, and investors were pricing in 6 cuts starting in March. Didn't take very long for those expectations to get cut in half down to 3 cuts for the year. And um, obviously March got pushed back really quickly. And if you had told me that, I would have assumed that the market was going to would pull back and correct it. After all, it had already done so well in Q4 and was at all-time highs. It would have made sense, but it's just continued to go higher. So I think that 10-year yields are a headwind. I think the rising US dollar are also a headwind. How much it impacts the market, that's the part I wish I knew, and I don't know. Do we just kind of pause and chop around? Do we have some kind of meaningful correction in the 2 or 3 to 5% range, something really minor? I don't know. I think it'd be healthy though if we did have some type of correction. There's a lot of people waiting to get in on the sidelines, that are waiting to put money to work. There's funds that are ready to put money to work, and there's this sort of sense that, like, when the train leaves the station, if you think you can get it at the next stop, it's one thing. It's when you don't feel like it's going to stop moving, that's where it becomes difficult to get back in. And a pullback would just be healthy, I think, to just sort of reset a little bit and give the market, set the market up for a nice second half.
You said the US dollar is strong. Can you explain to us a little bit more about why that's important and how that helps the country?
A strong dollar impacts different companies a lot differently. If it was a 100% domestic company operated in the U.S., a strong dollar is a good thing. But a strong dollar for a multinational company can make things a little tricky when it comes to currency conversions, and and taking their top line sales and converting it to bottom line profits. And so all companies are kind of created a little bit differently, and the dollar currencies are not the only consideration for multinationals. They have to navigate a lot of tricky waters. You see that right now with companies that are operating in China, are having a little bit of trouble getting their engines started, if you will. And it's just, multinationals are difficult. It's the only way I can put it, I guess. There's a lot of moving parts. There's currencies. There's their own economies in these different countries, and then obviously different regulatory environments. We see the regulations in Europe hit a lot differently than they do in the U.S., and that puts these like big multinational companies just kind of in tough spots when things don't line up for them.
And you talked about it in our pre-interview little meeting. You talked about a lot of cash being on the sideline, and you had just mentioned it again. And the markets here at the very beginning of the second quarter is selling off a little bit. I think people taking some of that 10% profit off the table, figuring like you are, that it would be healthy for there to be a little bit of a correction. Let me keep my cash here. So if it comes down 3, 4, 6, 7%, I'm going to put that cash to work for me. Is that how it works, or is there some other reason for people to keep cash on the side?
So I think that for being such a basic asset, cash, it actually has a fairly, it can be a little bit complex when you look at all the moving parts and the sort of the whys, why people hold cash. And look at where look at where interest rates are now, right? Like you can put money in the bank in a savings account or, money market accounts are at an all time high. People can go and get a risk free return just by parking cash in the bank. And that kind of acts as a hedge, I think, a little bit. I don't know that a lot of people talk about it like that, but I kind of think of cash on the sidelines as a hedge for the market because um, when the market does pull back a couple of percent, that's an opening for investors to take some of that cash off the sidelines and put it to work. And, you know, eToro does a quarterly survey every quarter, we do a quarterly survey with 10,000 retail investors. And it's got actually some pretty unique insights into how they're approaching the markets and what they're thinking about. And we found that in our last survey, 77% of retail investors were holding a cash asset, which is fairly high for our findings and was the highest that we can go back over several years. But with interest rates on expected to decline, a majority of those clients were looking to put that cash to work. And I think that kind of speaks volumes, not just at the retail level, but also at the institution level. If interest rates are going to come down at some point this year, and that's the expectation, that cash is going to earn less money pretty much overnight. That rate's going to come down. And so investors are going to say, well, if I'm not getting 4% and I'm only getting 3%, or I'm only getting X percent, I might as well try to find somewhere where I can find that money to go back to work. And when you look at the stock market, it's up 10% in the quarter. It seems like it's a natural place for them to start putting money back to work, just so they don't miss the next move up.
Right. I actually just moved money into a high yield savings account because it was, getting that 0.01% kind of, it drives that knife in and you're like, ouch. But it's like, that's why instead of putting into the market, and it is money that, I revolve and use. So I put that into a high yield savings. So businesses are doing the same.
Yeah, I mean, and it's a safe, you feel safe doing it. I think it gives investors a level of confidence knowing that not only do they have cash, which always just is a nice feeling, but it's also nice to know that it's earning something. So there's not a huge rush to move away from it unless there's an opportunity, right? So when we do have a notable pullback in the market, or when interest rates do come down, that's when investors start to think, okay, what can I do differently with this money? Where can I put it best to work to make a better return for myself?
So let's talk about the market a little bit. We went through I guess in the fourth quarter and the first quarter, talking about AI and how fantastic it was, and all the talk was about the Magnificent Seven, which is now the Fabulous Four, and those are actually companies that have cash to spend on AI, and some of these others have to go out and borrow money or have other issues like Tesla now that they've delivered fewer cars and their stock is coming down. So it's a huge issue. Energy was the top sector this past quarter. And look, I know that oil prices are going up and we can get into that a little bit, but how did energy creep in there when tech was all the rage?
Man, lucky for me, I pay a lot of attention to the sectors and the various sector strengths. We do a week by week analysis and keep a close eye on it. But even for me, energy snuck up, right? I mean, it didn't do exceptionally well to start the year. It was actually kind of a disappointing start, but energy ended the quarter on a 7-week win streak, and it really, that was enough to take it from doing okay to being the best sector in the entire market. So it really just, I think, speaks a little bit to the broadening sense of the participation in this rally. If we're looking at just the US markets, right? We have the Dow, the S&P, and the Nasdaq all at new highs, but we also have so much sector participation. If we go back, it feels like a long time ago, but it was really not. 9 to 12 months ago, we were coming out of a regional banking scare, which seemed like it was going to be a huge problem. And we had, I don't know if you want to call it the Magnificent Seven plus Eli Lilly, the Magnificent Eight, maybe. It was like there was the only stocks rallying. And even when you go through the whole year, all of 2023, in that really strong fourth quarter from a lot of different groups, communications and tech were the two leaders, and they were both up more than 50%. And you might as well call that both of those names tech. They're so dominated by the large tech companies. So this year we have, I believe, it was seven sectors. Seven out of the 11 S&P sectors were up 8% or more in the quarter. That's really significant, and it really shows how much the participation in this rally is broadened. It's not just tech, and for once, tech looks like they're just treading water. They're coming along for the ride in the market. They're not necessarily underperforming, but short of a few really strong pockets like Nvidia's one, Meta's another, Netflix is doing well. But outside of some of those areas, they're being normal. They're being like a normal sector, and we're seeing strength in other sectors, which is so great, especially the cyclicals. Like look when I look and see industrials doing well, financials doing well. I have a really hard time being bearish when I see those names doing quite well.
So we're seeing for a while everybody's like, oh, the S&P is being buoyed by the Magnificent Seven. Now we're seeing a point where others are all those other stuff, 493 stocks, they're kind of, a lot of them, not all of them, but some of them are actually catching up, and something you should keep your eye on if you're looking to hedge your bet or stay safe or not put all your eggs in one basket.
Yeah, and I think it just goes back to the more participation in the market. When you look at the S&P Equal Weight Fund, that for a long time was a one of the bears' big arguments was, okay, yes, the index is hitting new highs, but the equal weight is really lagging. So that just shows, like you said, how strong the Magnificent Seven's been. It's buoying the index. We are putting too much stock in the market, thinking it's strong, and it's not. It's really just a handful of names. Well, now the equal weight is also at all-time highs. So it really is highlighting how many different names are participating in this rally. And it just speaks to the strength in the bull market that we're seeing really for the last 6 months.
So if there is a correction coming, and I'm not talking 10, 15%, there could be a correction coming. Does someone protect themselves against that? Like they could take profits now, I guess, leave cash on the sideline for when that happens. Or is there some place they could put their money? I don't know if it's gold, precious metals, Bitcoin. Is there some place you put your money to kind of hedge your bet like that?
Yeah, there's so many options in the investment world, figuratively and literally. Um, when look across the board, that also kind of catches my eye. It's the U.S. indices are doing well, with the exception of the Russell 2000 is really the kind of the laggard of the group. But when you look at Bitcoin, that recently hit all-time highs, a little bumpy since, but for that to get back to all-time highs, I think speaks a lot of that asset class. The fact that it made it through yet another bear market and once again found its way back to all-time highs, I think it just speaks to its longevity and gives probably long-term bulls some confidence that it's not going to be killed off. It does have a relevancy in today's investor. And you can argue the same thing with gold goes through its ups and downs, and where people love it and hate it. And you have certain investors who will always love it, but gold's at all-time highs. So it's not limited to the US. If you want to look at different countries, they're finding themselves at all-time highs. I mean, Japan is hitting is an all-time high, but it took decades for that to happen. Germany, France, Denmark. I mean, we're seeing strength really across the board, and it's really encouraging. If you're a risk on investor, I know gold does not typically fall into the risk on category, but in general, it just is reassuring to see so many different assets across so many different groups performing so well.
Yeah, you brought up other countries, and I'd like to talk a little bit about oil and the geopolitical problems we're having. And I know that, you know, oil is starting to creep up. It's now in the mid 80s. It was 78, $79 for a little while. It's creeping up. We have the summer travel season coming up. How much does the geopolitical problems in the Middle East, in the Ukraine, and stuff like that affect oil? And now we have OPEC saying, you know what, we're going to cut production. So you see oil is something that's going to continue to creep up into the 90s at some point?
Yeah, oil's one of those. It's one of the really trickier commodities out there. It's a supply demand driven market, but it faces a lot of things that can impact it, from um, dollar strength, dollar weakness, to geopolitics, which you just mentioned. Especially with everything going on over in the Middle East, it does bring a rise up a worry that oil prices can continue higher. And the unfortunate part about oil prices is it has a direct impact on the consumer. And it doesn't necessarily have to be, oh, I drive, whatever, an hour and a half every day in my commute to work. It can be, it affects a lot of different things, whether that's just shipping and transportation, logistics, and driving, of course. And that's where it really pinches a lot of Americans, especially Americans who don't necessarily have a lot of wiggle room in their budgets, who, you know, it might cost someone, after oil's run enough, it might cost them an extra, $20 to fill up their tank. But you multiply that out over maybe two cars in the household, everyone filling up once a week, that could really pinch them at the end of the month. And that's the unfortunate part of oil. I don't know that, I don't know how long it can rally or how far it will rally. The low to mid 90s kind of seems to be sort of the kind of topping point, where at least enough at least enough supply comes back on the market to kind of temper prices back down. My hope is that that's the case. I personally don't like to see high oil prices, because I don't like to. I know that it just acts as an invisible tax on the consumers, and on costs of doing pretty much anything that involves moving one product from one place to another. So the goal, the hope is that it doesn't rally too far. If it does get into the 90s and stay in there, I don't know, maybe that gets the calls going for 100. You never like to see that, but we'll just see, play it by ear. The summer driving season's not exactly a great time for it to be running into, but we'll see how it is in a couple months.
It seems to always be that way, that OPEC somewhere around, March, April decides, oh, we're cutting production. Well, of course you are, because now I have to drive to, wherever I'm driving to for a little vacation. But we have, Bret, last topic is, we have earnings season coming up again. Now that first quarter is over, it's earnings season's right around the corner. What are we expecting? I know, last earnings season, it was all about AI. You heard about Meta. You heard about Amazon pouring billions into AI. Is there something that you guys are expecting, or any surprises that you think are on the horizon?
Yeah, so we're coming to first quarter earnings. It's more of a, how do stocks react to the news, not necessarily what is the news. And when you start to see some of the smaller headwinds creeping into the market, like we touched on earlier, the rising yields, the rising dollar, do you start to wonder, are expectations a little too high? Is this maybe act as a catalyst to take a little profit off the table? I don't know. Maybe it could have the complete opposite effect, honestly. I mean, earnings could send the market back up to new highs, but it is a scenario where I do wonder, maybe it's a moment where we either, maybe we sell off a little bit into earnings and take those expectations down. That really would be the a nice thing to see. But if not, if we run right into earnings, it might act as an excuse for things to come in a little bit. And I hate to keep saying expecting a pullback and looking for a dip, because I really do look at it constructively. And I look at the fundamentals constructively too. Like, Q1 earnings season isn't anything necessarily to write home about. We're not seeing gangbusters growth or anything like that. But for the year, it's expected to have the S&P is expected to have a good year of growth. Expectations are calling for more than 9% earnings growth for the year, and for next year, it calls for an acceleration up into double digits. So I think investors are looking just for reassurance. They're not necessarily looking for anything this quarter that, blows them away and wows them, but more of a reassurance that, hey, we're still on the right path. They want to hear the guidance. They want to hear management teams speak optimistically. And it's important for investors to remember, the market's a forward-looking, mechanism. Whether you want to say it looks forward 6 months, 9 months, 12 months, whatever, like your kind of, whatever you think it is, I guess, personally. But um, the market looks forward, and the market is looking ahead and says, I don't know when the first interest rate's going to come. I don't know if it's June or July, but a year from now, I see lower interest rates. A year from now, I see 9 or 10% earnings growth under our belt, with a little more growth to come in the next 12 months. So I think that's an important thing to remember, is that the picture looks pretty good. The outlook looks pretty good for us. And the economy continues to hum along. Now, if things change, then obviously everyone has to change their tune a little bit. But where we stand right now, things look okay. And I think one argument that people do like to kind of drum up is a valuation argument. They like to say, "Oh, we're at all-time highs," or "Oh, the S&P is trading at about 21 times forward earnings," which is a little rich. But when you dig down a little bit into the sectors, it's only actually really a few sectors that are commanding a premium valuation. You look at, I believe it was like 8 out of 11 sectors are actually trading at a discount to their pre-pandemic valuations. So when you kind of look at it like that, that it's there are catalysts to continue this market moving forward and moving higher. And um, unless we really run scream higher at this point and those valuations just become absurd, we we do have the catalyst and the fuel to keep this thing running. It's just a matter of, how does it get to where it's going to go?
And how expensive will that fuel be? But Brett, we thank you so much for joining us, and we'll get through earnings season, and then we'll talk to you again, and we'll figure out where we are, where we're going. Hopefully, by then, we'll be on the cusp of an interest rate cut, and like you said, it's not going to do a ton for us, but it's the trend. It's like you sell on the news because it's gone way up. Hopefully it's the trend that people are bullish about.
Yeah, we can only hope. And thanks so much for having me. I can't wait to be back.
If you need help being financially resilient, please head over to Wealthion.com and sign up for a free, no obligation consultation from one of our vetted registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. Thank you for watching, and until next time, stay informed, stay empowered, and may your investments flourish.